is a quiet revolution taking place in the investment process at the moment. This revolution is called factor investing. Factor investing has the potential to redefine the way long-term investors construct and manage their portfolios. In the past, investors really had two choices to implement their asset allocation: passive investing and active management. Passive investing is simple, transparent, low cost, but only captures the market return. Active management offers the promise, the possibility of outperformance, but typically comes with higher cost and higher complexity. Factor investing bridges the gap between these two other options and combines some of the benefits typically associated with passive investing, for example, transparency, simplicity, and low cost, while also offering the possibility to outperform the market by harvesting risk premia associated with systematic factors. Essentially, factors are common characteristics that cut across stocks and explain the performance of portfolios over long investment horizons. Factors are well documented in academic research, and there are some solid reasons, solid explanations why they may provide a premium. The most important equity factors are value, size, momentum, volatility, quality, and yield. Factors are not a new invention. Portfolio managers have been using them in how they select stocks and how they manage their portfolios for many decades. In fact, some of the world's most successful investors, such as Warren Buffett, the performance of these investors can be linked to the way they systematically invest in stocks with certain characteristics or factor exposures. What investors have realized recently is that factors can be separated from active portfolios and can actually be captured and reflected in simple and transparent indices. MSCI has been a pioneer in developing factor indices, and there are currently approximately 60 billion of assets benchmarked against MSCI factor indices. Well, look, factor investing is not a silver bullet. Factor returns are quite cyclical and volatile. The returns of individual factors can underperform or outperform the market for several years in a row. In fact, if you look back at the period 2003 to 2008, before the financial crisis, we had value-based strategies performing well, while risk-based strategies underperformed. Since the financial crisis, actually value-based strategies have done quite badly, while risk-based strategies offer outperformance. So it's very clear that any individual factor can lag or lead the market for long periods of time. So as a result, we think that there are diversification benefits associated with combining factors in a portfolio. And that's why MSCI, in addition to offering factor indices that target individual factors, we also offer indices that combine several factors within the same index. Factor investing is complementary to passive investing and active management. Allocations to factor indices sit between traditional passive allocations and active mandates. Cap-weighted indices remain an appropriate and efficient method to capture the return of the broad equity market. They are the only truly passive buy and hold investment strategy. They offer very high investment liquidity, very high investment capacity, and low turnover, and therefore low cost. On the other hand, active management will remain central in the institutional investment process as well. Active portfolio managers can add value through market timing, sector rotation, and stock selection. In fact, the advent of factor indices will help true active managers demonstrate how they're generating alpha and how they're able to add value over and above what is possible through simple factor indices.